Hi, and welcome back to the Preparing for Retirement podcast. I'm your host, Mark Cram, Certified Financial Planner in Durham, North Carolina. And today's topic is going to be about dismissing old concepts. So is paying off your house the smartest thing you could do? And what's the return on the equity in your home? And could your equity be doing more for you? Well, let's look at these concepts. In the book Rich Dad, Poor Dad, Robert Kiyosaki makes the statement that he finds that many people struggle because they simply cling to old ideas. And when those old ideas don't work anymore, it makes it very difficult for us to achieve success and to reach true wealth. Marion Snow has written a book called Stop Sitting on Your Assets. Marion is a scientist and a mortgage lender, and Marion says in her book that over 98% of the advice you will get is going to keep you in the status quo. And the reason is because 98% of the people that you get that advice from are already in the status quo. And they're not going to be able to help you because they can't see the answers that are out there, because they're already living in their own paradigm. And the last book is a book called Last Chance Millionaire from an author named Douglas Andrew, who's written a series of books which he calls the Misfortune series. And Douglas says that all dogs barking up the wrong tree doesn't make it the right one. And what he's talking about is that all of these people out there who are putting money away in their 401ks and IRAs and are paying off their home mortgages as fast as they can may in fact be barking up the wrong tree. We've looked at some of this already, but just because everybody's doing it doesn't mean it's the right thing to do. And maybe we should be looking at some new concepts and ways to be working with these ideas. Most of us have been working with our mortgages using a traditional amortized loan. With these loans, we pay a single payment of principal and interest. A lot of times we send in extra money trying to pay down that mortgage even faster, and of course when we do that, we are reducing the greatest tax write-off that we have. When we send that money in, of course, we're giving it to our lenders, and then they have access to it so that they can use it for their benefit. If we, however, want to get our money back out, we have to requalify in order to have access to the equity in our homes, which we feel is our money. And what's the return on the equity in your home? Well, the return on the equity in your home is zero. Zilch. Nada. There is no return on the equity in your home. It is simply there to be used by your mortgage lenders and by the banks who have given you that money to use. So what about using an interest-only mortgage? This is another concept that is out there and has gotten some good press and some bad press. But when you do an interest-only loan, you are only paying the interest on the money that you're borrowing. You could actually take the excess portion, which would be the difference between what it would cost you to do an amortized loan and what it would cost you to do an interest-only loan, and take that principal portion and put it aside for yourself rather than giving it to the lender, thereby creating, that excess cash flow that's in your pocket, not in your lender's pocket. Now, if you do this and you use an interest-only loan, it's very important that you have the discipline to put that money away. And when you do put it away, it should be in a place that's safe, a place that's liquid, and a place where you can get a good rate of return on it, preferably in a tax-preferred environment instead of the walls of your home. So the one thing you need to understand is that you're going to incur a cost no matter how you decide to pay for your home. If you pay cash for your house, you're going to save the interest on the money that you would have borrowed, but you're going to lose the interest on the money that you put in that house that you could have invested someplace else. We call this opportunity cost because you've lost the opportunity to invest that money someplace else. If you borrow the money in the form of a loan, then you're going to pay interest to the lending institution for the privilege of using their money. But in this case, as long as you're going to incur a cost either way, why not take the one that gives you a tax deduction for the money that you're going to use? So in preparing for retirement and dismissing these old ideas, you can use assets that you already own to help you actually create wealth. And you can use the tax laws in existence today to your advantage. And you can use that to create a safe retirement plan that you can use to increase your retirement income by as much as 50%. And we'll see that in later issues of this podcast. But for now, if you want to receive more information, please check out the website www.equitymaximization.com. That's www.equitymaximization.com. And we'll look forward next time to exploring these ideas further as we help you prepare for your retirement.